There is no way any company is ever going to catch Amazon on logistics now, having seen like this thing and the absolute scale of them. So like we went to a modestly sized fulfillment center, which is only, I think it's 500,000 square feet. It's such an incredible machine, the way these like spaceship facilities operate.
Had I not sold any of my Amazon shares or Google shares, or like 20 years later, my material wealth would have been massively, massively greater than it is today.
The last time the S&P closed 9 days in a row was 2004. And if the S&P closes like a 10th day, which will be tomorrow, Monday, that'll be like the longest 10-day streak. The last time was 1990. And if we get to like Tuesday, that's like 1968. This is quite historic times.
Trump, one of the things you could say about him is he says whatever is on his mind and then he does it. That's what makes him such an anti-politician. For whatever reason, that's true. That seems to be true.
Just be smart, be diligent, and don't let fear take control. Like have a plan and respond, don't react. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hey, and welcome to Wall Street Wildlife with Christoph and Luke in a feature-packed episode this week. After the chaos of tariffs and Liberation Day, markets are currently on the longest winning streak of the last 20 years. That was pretty unexpected. Yeah, that bull is coming out if you're on the YouTubes. We've had some big tech earnings. What actually happened? How does the world feel different? What does big tech think about Liberation Day? Plus, Katrina and I had a visit to an Amazon fulfillment center. I'm quite keen to tell you about the robots we saw there. That was pretty exciting. And in a brand new segment, we have a very interesting guest appearance from one of our Patreons, and he's got a question for us. We're going to field that question live on the show.
Amen and hallelujah. You know how death has been following me around recently, Badge?
I do.
It came knocking on my door yesterday. And maybe I'm exaggerating a little bit, but I'm allergic to bee stings, and I was working on the house fixing things up, and a wasp got me. And if I showed you both my forearms, it got me on the forearm.
Right.
I'm like Popeye. One of my arms is like Popeye. Now the thing is, I'm also, this happened yesterday. I'm like, okay, no emergency room visit needed. But now, as we're talking, I'm starting to feel my mouth be a little numb.
Oh.
And that's the real scary thing is you die if your throat closes.
Yeah, you're going to go into like anaphylaxis live on the show. Excellent.
Yeah, I hope I make it through this episode. And if it's the last one, it's been it's been a hell of a run, buddy.
I think you're going to be fine. I was just coming from watching episode 1 of The Pit, which is like the new ER. So it's far more dramatic. I don't expect you to die on the show if you got stung yesterday. Well, you are sporting a beautiful bee hat today to mark the occasion. Does it say horny or honey?
It says honey.
Honey.
Keep your mind out of butter.
All right, very good. Well, I got stabbed as well today. I gave blood today, by the way. Everybody, go give blood if you can. Apparently, today was my 19th donation. You don't get anything for 20, though, when I go back in a couple of months' time. But I electively stabbed myself the other day because I now got one of these on. Do you know what that is?
Oh, is that a glucose monitor?
Yeah, a CGM, a continuous glucose monitor. So I've been reading about this thing called Zoe, and it's too expensive. I'm like, screw Zoe. I don't want to give them a ton of my money. So I just went and bought like 2 boxes of Freestyle Libre 2 Plus from Abbott. And it's like a CGM monitor. You literally have this like applicator with a huge freaking needle in it, but doesn't hurt at all. Plonk the thing onto your arm. It lives there for like 15 days each one. So I'm doing a 1-month experiment. But the gadget, like that thing on my arm, is literally talking to my phone in real time over Bluetooth and just like updating my blood glucose reading. And I'm using Gemini. We're going to talk about AI quite a lot today's episode because, well, we always talk about AI, but big tech earnings is all about AI. I'm using Gemini as my nutrition coach. So I'm like telling Gemini in one long conversation over the last week or so, like everything I eat, drink, exercise, giving it my, well, I will correlate it with my blood glucose readings at the end. I'm going to try and figure out kind of what kind of foods are good and bad for me and all that kind of fun stuff.
What's trickiest about science is causation, figuring out what actually causes what.
Yeah.
And I wanted to say, for all you people watching on YouTube, Badger does look extraordinarily svelte, very debonair today. You more than usual, but I don't know if this is his new like health kick or it's because he's sporting some seriously fine Wall Street wildlife merchandise. So I don't know, but I don't know. It's going to be hard to figure out, if you make all these changes and you start following this new diet. What is the real cause for your well being? It's going to be hard to tease out.
I got a haircut. I looked pretty scruffy last week. That's probably the
Oh,
only thing it is. Yeah. Yeah.
okay.
Plus, it's I don't know. Maybe the lighting's different because it's nighttime. So it's currently it's Star Wars Day. It's the 4th of May. May the 4th be with you, Christoph.
Oh,
Yeah,
and also with you.
yeah. It is, but it's Sunday. We normally record on a Monday. It's Sunday because you've had some chaos at home. So we're recording like the night before we normally record.
Yes, the chaos was my deck collapsing a few days before leaving for Europe.
Okay.
So, of course, right. So, speaking of, next time we record, I'll be on your side of the pond
Awesome.
for
Yeah.
much longer this time. So,
Yeah. Very good. Very good. How is the weather in Italy? Is it looking receptive to you?
I believe it's a lot chillier than I've ever been used to. I've only been there during the hot months, so I'll be bundling up.
Good. Well, it's got to be a relief from anyway the fearsome summer of Austin.
Oh yeah, no, this
Yeah.
is the best. This is the best plan ever. So, speaking of chaos, the markets, right? It's why people they tune into us. They want to know, is the thing going up or is the thing going down, Badger? Is the market going to go up or is it going to go down next week? Tell us.
This is so unexpected, right? I did not expect what seems to have happened. I don't know how long it's going to last. I haven't got a freaking clue how to navigate it. What's going on? So we had Liberation Day at the start of April. Tariffs, things got worse. Like tariffs were way worse, way more complex and way more volatile than anybody expected. If you see this, like this is the S&P through the month of April, and like we were down. Well, I think we doesn't show it on here. These are like the closing prices. I think we were down like 19% at some point from, or at least from like the highs of maybe February.
Higher 20. It was 20 something.
Yeah, like a serious drawdown. Things are looking really gloomy, and now, I mean, if you just look at the current, the last 9 days, the S&P has closed higher for 9 days consecutively. And that actually is a bit of a record. So the last time the S&P closed 9 days in a row was 2004. And if the S&P closes like a 10th day, which will be tomorrow, Monday, that'll be like the longest 10-day streak. The last time was 1990. And if we get to like Tuesday, that's like 1968. This is quite historic times. Is this a false dawn? Like, we'll talk about big tech earnings. I mean, I've got my opinion about kind of what's going on and where we're going to end up, but like, I don't know. Like, the stock market seems detached from reality at the moment.
I love this quote. There are decades when nothing happens and weeks when decades happen, by my buddy Karl Marx. uh, sometimes I want to say, I don't know how this will sound to you, but the most obvious thing, most obvious reason or cause for something, because it's so simple, people don't look at it or don't think about it. The purloined letter, the gun that killed the victim is right there in front of you, but you're looking in all the corners. Trump, one of the things you could say about him is he says whatever is on his mind and then he does it. That's what makes him such an anti-politician. For whatever reason, that's true. That seems to be true.
Yeah.
And he thinks of himself as this deal maker, right? This hard negotiator. Is it that much more complicated than he said he's going to negotiate? He's playing hardball. He starts saying, okay, here we go. And he's watching the reactions, and countries, the world is reacting, and that all this really is some sort of strange, transparent, global negotiation, and we're all witness to it at the table. And one side says, "Oh, I want this," so stock markets plummet. Other side says, "No," and then, "Oh no, we'll give you something." Stock markets go up, as though something that's usually done behind closed doors over periods of days, weeks, is now being done sort of by the hour. And the conclusion, after all of whatever the last, call it 3 weeks, the conclusion is we're right back where we started, because things seem to be sort of progressing in terms of negotiation, right? That things have been moved, goalposts have changed. So all the stuff in between seems kind of like a play by play, immediate reactions, but nothing else has fundamentally changed. What do you think of that?
I think it's too soon to make that judgment. I think a lot has changed. Like if I try and put myself in the shoes of maybe the CEO of a medium-sized business who perhaps imports like parts which we assemble into something and I sell something, or whatever it might be. Like if tariffs are impacting me in some way, like I'm going to be so conservative. I'm going to lock down like my expenditure. I'm going to cut costs. I'm going to have to pass on some of the costs to my customers and hope that I can retain my revenues. I'm going to have to eat a lot of the costs. It's really going to bite into my own margins. And I'm probably going to put a pause on any kind of discretionary investment because I just don't know how much money I might need in the future to navigate. Like I'm certainly not going to be like committing to building manufacturing plants in the US if the rules could change like next week, next month, in this really unstable, like just unknown, volatile political and economic environment. So I imagine most boards are having those kind of conversations, and like it's got a long tail. We're not going to see the result of those things for like probably the earliest another quarter, maybe two. Some of these things we might not see for like another year, but like these impacts, I feel like they're here, and I feel
Yeah.
like the main impact is a bunch of folk might find themselves like with unemployment rising, unfortunately.
Yeah, so I think I misspoke when I said nothing's changed. That's not what I meant. I was thinking more in the frame of like in the negotiation table,
Okay.
the fact that we made a round trip,
Hmm.
seems like what I was thinking more is the big question I think for a permanent bear market is, did something break? Have we eclipsed some sort of threshold after which there's no real recovery?
Right.
And right now, we don't know that, like you said. The other thing I want to point out, though, and this is perhaps good reason to remain cautious, like you're talking about, is bear markets are notorious for having big, strong bounces and then crashing back again. So I would, under no circumstances, look at this as though we've solved the problems. All I'm saying, I think, in sum, is that we have firsthand seats to watching the negotiations themselves play out with the market voting kind of hour by hour. That's all I see happening. And the fact that something might have gotten broken is to be determined, because, like you're wisely saying, too, when the price hikes show up in what is it, a matter of weeks now? Oh yeah, there's gonna be big headline news and updates on like all kind of bearish stuff. So we're not out of no woods yet.
Yeah. Yeah. What are you doing? How are you managing your own? Let's put King of the Jungle aside for a minute. I know you keep them both aligned, but like your real portfolio, your real money, how are you navigating it in your own life?
Yeah, right now I'm doing mostly nothing,
Hmm.
uh, except for a couple of short term timed bets, one of which I shared with our Patreons, sort of last minute kind of earnings bet that even if it didn't go well, I was okay with keeping it, and if it did go well, I was okay to take a quick profit. But that's a tiny little sliver, you know. it's mostly me sitting there and just letting the cash, the cash buffer, uh, just sit there until something really looks egregiously undervalued again. But we haven't gotten there yet. So
Okay, that's interesting. I didn't know that was your strategy, because that's broadly what I'm doing too. We did that Amazon fulfillment center tour, and I've been wanting to add to Amazon, and I'm really enthusiastic about doing that, having seen like this incredible facility in action, but still a relatively expensive stock. And I feel like balance of probabilities, I'm probably going to get a better value point if I can just kind of hold my breath for a couple of months, maybe.
yeah, though I want to return to your previous comment. I think for our listeners and our patrons, what I'm doing with King of the Jungle portfolio is really, I think, the best view into really what I ought to be doing. Because remember, in our private lives, in our personal lives, we have all kinds of other
Hmm.
constraints that affect us personally, but like, paying for elder parents care, a collapsed deck, whatever, that all of a sudden, right, real life tells me, oh, I wish I could buy the stock, but I can't because I have to deal with X, Y, and Z. Whereas in King of the Jungle, the beauty of it is we get $200 a month, right? And that's kind of the window of how do I allocate this stuff, right? And it's not about the sheer amount. So how did I spend my $200? And you saw, or our patron saw on our Dolphin channel, that I bought two companies, made a short-term trade on the third, and kept the rest in cash. And that's kind of honestly the pretty close to how I'm navigating this.
Fair enough. Fair play. Very good. Do you want to chat about those, or should we treat it as a different episode, like the actual trades?
Uh, I think we should stay macro for now.
Yeah.
I mean, the big picture stuff. So let's talk about the big tech earnings that
Yeah.
we got wind of.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks, from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Let me share a few numbers, but I've got some thoughts around the context of this, and I welcome your input on this. So we've had earnings from Amazon, Microsoft, Alphabet, Meta now, and I think there's a few others coming next week. And in the round, like generally, everyone's putting in like very solid, decent results. And I wanted to focus on one particular aspect, but just to give you a sense of it, like Microsoft Azure revenue growth up 33% year over year, with AI being like more than half of that growth, and growing. Amazon, really strong AWS sales growth, up 17% year over year to nearly $30 billion. Again, AI being a key factor there. And the aspect I wanted to focus on was what these guys, the hyperscalers, what they're doing around their capex for AI, like where they're spending money and why. Because, bit of context, right? So we've just had earnings, and earnings were for most of these companies like up to the end of March, Q1. Like some will call it different things, but essentially it's like the period up until 31st of March 2025. So this is all pre tariffs and chaos and complexity. And so like we wouldn't, even if like these companies, like their earnings are going to get hit heavily, we wouldn't see it in those numbers. We'll see it in next quarter's numbers. But what is instructive is what the companies are planning, like how they're forecasting, and also how they're projecting spending. Because if we go back to that comment I made a few minutes ago, like if I'm a small to medium enterprise, I'm probably locking down my spend, I'm trying to be conservative. Well, these guys ain't doing that. Most of them are materially increasing their capital expenditure guidance for like full year 2025. So, for example, Microsoft is increasing its capex spend on AI to $80 billion, 80 billion. Alphabet are forecasting $75 billion. Amazon over $100 billion. Meta somewhere in the range of like mid 60s to $72 billion. These are like serious checks. Like a large part of that check gets written to NVIDIA, right? Because many of them are buying NVIDIA hardware, but they're spending money on a bunch of other stuff. And like, this is the interesting thing. Like, these companies, irrespective of what's happening in the bigger picture and like the political thing, they're still charging at an ever increasing pace at trying to win the AI race.
Yeah, it's so weird to being in the middle of a paradigm shift.
Mhm.
And I'm sure everyone is not sick and tired necessarily, but of course, nobody talks about anything but AI these days. But if you actually think about that this is, Internet 2.0, I mean, in the birth of the Internet again, but this time something that it's like we were coached. It's almost like we were coached with the internet 20 years ago. Oh, this is what it means to reshape the world in such a drastic, unexpected way. And now everyone's paying attention and knows the power of what's around the corner. And so nobody's holding back. Right. I don't know if that's a good analogy. Back then, when people were looking at Amazon expanding from this thing to another thing, many investors were like, what are you guys doing? Like, you're just a bookstore, right? But nobody has those doubts anymore. So it's like full steam ahead. We can't be left behind. All the spoils go to the winners. And of course, with this stuff, we're talking about actual world domination, honestly.
Yeah.
These are existential level investments. And that's why I think every company feels like they have no choice. It's not even like it'd be nice to have, or like, look at us being smart and thinking ahead of everybody else. It's more like, if we don't, the other competitors are just going to take over everything. It's kind of unsettling in those kinds of ways. Like, that's why I think it's so massive.
Yeah, it's big, and you're right. I mean, we've said it on previous episodes. These companies do see it as a existential threat. Like, whoever wins the race, everybody else loses the race. The better outcome for society, I feel, is if like everybody gets there with AI, and there are lots of different flavors of AGI, and then maybe we have some sort of like self-regulating ecosystem. But if like Gemini wins, if Google wins with DeepMind, and they're my horse in the race, pretty much. Like, I don't know if that's a good or a bad thing, but if there's only one solution, because they'll so quickly dominate the industry with their superior technology.
Right. So I guess to sum up, I don't know if we want to offer any more granularity about the earnings, but basically they were really solid with this, like you were saying, locomotive that is full steam ahead, no stopping, tariffs, no tariffs, doesn't matter. I was looking into one of my top holdings, and the CEO, Dan Roberts of Iris Energy, recently tweeted, quote, "The 7 trillion race is on. McKinsey just confirmed what many of us already knew. AI is triggering a compute boom, with data center investment projected to hit 7 trillion by 2030." And then he talks about his own company and where it's positioned. I'll talk about that in a bit. But in that 7 trillion, 5.2 trillion is related to AI infrastructure.
Mhm.
5.2 trillion. So, yeah, I mean, it's kind of staggering, I suppose, like how quickly all of this is going to happen. With this, has more capital, Luke, ever been deployed more quickly in like this single focused domain by humanity ever? And how, like, it's magnitudes, right?
Yeah.
It's magnitudes bigger and larger. So it's like even the companies that had foresight to invest in the early internet stuff, nobody, I mean, I don't know what the relative scale is. Like, we're talking about a few billions at most early on, and cloud picked up, right? But that got pretty big. But when you're talking about trillions, all of a sudden,
Yeah.
whole different thing.
Even like inflation adjusted, this is like an order of magnitude more investment than, well, almost more than any private entity has ever been able to spend before. Like the Magnificent Seven are called that because they're just so dominant, like they're so huge, and their market caps, rival large countries. And so like these companies today are at such a scale, they can make these incredible investments. And as you said, like they see it as an existential threat. They see this as a race they have to win.
Right. And one specific point about that, this is what I might take away from that book I read some time ago, Chip War, which I loved and I keep recommending to people. It's a whole different thing when your own government knows that, I'm speaking here from the perspective of the United States, when the United States government knows that it has to invest in this technology because if it doesn't, China then takes over the world. Right? That framework is just a whole different way of thinking than 25 years ago at the birth of the internet, where sure, some companies are going to build out all kinds of cool stuff, but never was it like, if you do this, we die as or die, our country dies, right? Or our way of life dies. So just a whole different ball game. And I'm having a whole bunch of these insights and flashlight, these kinds of, I call them like, light bulb moments, where even though I've said something repeatedly, it takes the seventh time I say it out loud for it to kind of fully, like deeply, like, oh God, I get it now. And I had another one of these. Maybe this is a good segue to something that, to go back to what Daniel Roberts from Iris Energy was saying. It finally kind of really hit me big time when I was prepping for this. I'll read further in his quote, in his tweet. He says, "That's why we're building. At Iris, we're not waiting to see how this plays out. We're already deep in it. Because the real bottleneck in AI isn't models, it's power and infrastructure." And then he lists a bunch of technical things his company achieved in the preparing Texas for the build out of these data centers. And then he continues, says, "And here's the truth. If you haven't already started development, good luck getting grid connected power at scale online much before 2030. Grid queues, permitting, construction, it all takes years. That's why we started in 2018. So I kind of think of this, and this is because this is okay. Another side note. What I'm talking about here isn't me like pitching Iris Energy, ticker symbol IREN. It's really not about that. It's more like stepping back and kind of seeing more clearly than ever why this company is in my top 5 holdings, because it so clearly maps onto exactly what the Magnificent Seven earnings are showing. The capex is unabated, and this guy is saying what the rest of the world doesn't see yet, or what most people don't really understand yet, is it's not the stuff that's in front of consumers, the fun with the models. It's like all of this will require absolutely gargantuan amounts of energy, and where are you going to get it when building it out literally takes years and years, the contracting and the permits and getting the land and stuff, right? So you could have all the demand you want from Meta and from Tesla and from, all the, right? But it's not available. Like, in other words, that's the bottleneck. So I want to position myself as an investor. If I buy this thesis, which I completely do based on the numbers and everything we're talking about, what companies are going to be forced into being in the right spot at the right time, right? Because of these trends unfolding. And to me, that's like, that's Iris Energy as one example of that in my thinking about it. What's extra curious, maybe this is a little pitchy sounding, but what's really curious in this moment is that the market is not giving credit to Iris, the company itself. And it's interesting to think about this because no contracts have actually been signed, right? They're just in the build out phase, right? And that to me again is what smart investors do, in a sense. It's the whole go to where the puck is going rather than sort of waiting for the what's it called, the evidence to already be in hand once the shares have already been bid up, magnitudes. So what I would like to hear from you in this sort of counterpoint is like, you hear me kind of now pitching this company because of these trends that I'm going on about. What's the counter argument here?
Well, no, there's not. I mean, there isn't one, right? I totally support that idea. But I think back to my own recommendation for 7 investing years ago. I think I was too early with the idea, really, of new scale power, so, ticker SMR. Like, one of the main applications in my mind then, in my thesis 2 years ago, was like, you need power at the point where the data center is, because you've got to have the energy to power these things. And the US recognizes this, right? I think there was something in the news just last month. The Department of Energy have put out like a RFI. Basically, they've said to like a whole bunch of companies, like, work out how you can supply power at this sort of gigawatt level to support the data centers of the future. And there's a whole bunch of companies. Interestingly, new scale power wasn't in that list, so kind of a fail there. But a whole bunch of other companies looking at other ways of using like different forms of nuclear power and other power sources to try and provide, like, support the infrastructure that the US recognizes it needs to keep parity with China.
Exactly. So I think here's for our listeners, the way if you could see inside my mind, I'm going back to the early internet again, and I'm trying to remember what it felt like during that moment, right? And remembering that had I not sold any of my Amazon shares or Google shares, or like 20 years later, my material wealth would have been massively, massively greater than it is today. Even though there were all these drawdowns, painful drawdowns when people panicked and bubbles were bursting, right? And all this and the other thing. Stay focused. I suppose here's the sermon. Stay focused on the fundamentals are driving this now even greater tsunami.
But again, though, we say that with hindsight. Like, I totally agree with you. But at the time, like, it was probably quite hard to tell the difference between like an Amazon and a pets.com. Like, one was selling books and one was selling like pet stuff, and one like completely failed and blew up, and then the other became one of the world's largest companies. It's like, how do we do that analysis today and figure out who the future Amazons are, not the pets.coms?
Well, that's a great question. I think, back then, the reason that bubble burst was because people found out there is no revenue coming in. It's just like, versus, I think the greatest alpha in the end comes from people actually doing the work in terms of research and saying, are things being built or not? Is this an idea, or are people actually putting in man hours to do this thing? Right. So the Magnificent Seven, we know they're already building stuff. That's not the point here. But in terms of emerging companies, and when I look at iron, literally they are breaking ground in West Texas, and every day there's drones flying around and showing you the things expanding. Right. That's one of these proof of points, versus, I don't know, what would be an equivalent, like some sort of fancy gadget that runs on AI that solves some problem that's really nice to hear about, but that's very different than like boots on the ground with shovels.
Yeah. I mean, there's lots of ways to play this. And I think we're now seeing like the first signs of the real economic value of this stuff to like the whole world. So I saw in the news in the last few days, we've had announcements from companies like Duolingo, Klarna, UPS, Cisco, even, that they've laid off people in the past. They're replacing those roles with AI and automation. Like, they're really using this stuff now. And we're not even talking here about like agents using AI for real to like run their organizations much leaner, much cheaper, because people cost is incredibly high, and you don't have like the labor complexities and all the other stuff. So this is how companies want to operate. I mean, it's not good if you are in one of those jobs, but it's real economic value to the world. And even if these companies like don't lay off more people, the people they do have, they'll be able to do a ton more with. Like everyone will become like a manager of many AIs, and maybe there'll be some sort of super AI coordinating the work of all those, like the human middle management. Who knows how this is really going to shake out? But my main point here is this isn't pie in the sky. This is real. And if it's real and there's like dollars to be made or dollars to be saved, and we're seeing now that there truly are, then this trend is like here to stay. And you can play this by owning like the guys that are building the factories, the guys that are making the semiconductors, the guys that are supplying the energy. Lots of different ways to play this boom, but this boom is not like this isn't a bubble that's gonna pop anytime soon.
Yeah, that's right. That's the, I suppose, main takeaway. And also the recent job numbers were pretty strong.
Mm-hmm.
Can we go full circle again to how we started the show and where we're at now? I think I want to say this. Feels like to me the volatility will not go away. I would not be surprised if the market crashes 10% in the next month. No surprise whatsoever, or 15%, right? Based on whatever next negotiation tactic. But now I'm not going to be surprised if it rebounds again strongly because of these trends that are now in writing. The data is clear. And what is growth? What is economic growth in the history of humanity but these moments where all of a sudden new things are capable of being built? And that's never been, what's it called, more sizable than in this exact moment. So, a major catastrophe will be probably some sort of self-inflicted wound, like a recession caused by too much gamesmanship in terms of political theater or some kind of dangerous war or something. But for us investors, it seems like stay put and take advantage of the volatility. That's what we talk about when volatility is your friend. When you have a big drop, take some bites, right? If it drops further, that's okay. You still got good value, right? If it rebounds, maybe take a little bit of profit. So I don't know. This is maybe a little short timer-ish stuff, but I myself try to take advantage of these ups and downs rather than, in a sense, doing nothing.
But if if you are scared of the volatility, the other end of that kind of spectrum, like you can do what Christoph just described and try and take advantage, maybe trim some stocks when valuations feel like they're really high, maybe add to some things when valuations feel like they're more reasonable. But like the only way you can really like damage your portfolio, possibly like existentially, is letting like the fear translate into like taking a bad action, like selling when things are down, getting out of the market, never really getting back in because you miss like that one day a few weeks ago where the market was up like nearly some crazy percentage digit. How much was it up? Like 8 or 9% or something in a day, something ludicrous. Don't remember. Anyway, it was like it was unprecedented, pretty much. You miss 1 or 2 days like that, and that's going to damage your returns for like probably this decade. So yeah, like if you do nothing, doing nothing is not necessarily a bad thing, right? Just be smart, be diligent, and don't let fear take control. Like have a plan and respond, don't react.
Exactamundo.
Yeah. So I said I didn't add to my Amazon stock, even though I wanted to. Should I tell you a little bit about why I really wanted to?
Yes.
Yeah. So Amazon fulfillment centers, like we've all probably heard of them, and probably something arrives at our door pretty much every day. Certainly if you live where I live, there's like an Amazon person showing up pretty much every day. So Amazon only found out recently, they do free 90-minute fulfillment center tours. So I signed up, Katrina and myself, we went along to one of those last week. And God, really interesting. Highly recommend it. I think they're doing
Did you wear like a hard hat and goggles, when people visit construction sites?
You have to wear a headset with like a microphone because it's loud in like the work environment. And then just you chill and you have a tour. So interesting. I don't know how deep you want me to go on this? Let me give some headline stats, just so you got a kind of sense of how ridiculous their infrastructure is. And really, like my main takeaway up front, there is no way any company is ever going to catch Amazon on logistics now, having seen like this thing and the absolute scale of them. So like we went to a modestly sized fulfillment center, which is only, I think it's 500,000 square feet. So just to put that in context, so to walk around, there's like a kind of gangway around the outside, this huge warehouse. It's a mile perimeter. So if you're, 1.6 kilometers just to walk around like the outside of the building. And the building has, I think, 5 floors. Like the first floor, which is like loading bays and where trucks come in. And then stuff goes on some crazy, like hundreds of kilometers of like treadmill things, like conveyor belts, up to different floors where they're sorted and picked and packed, and all these amazing things happen. And like Katrina said to me at one point, like, where does stuff like stored? Like nothing really gets stored. It's such an incredible machine, the way these like spaceship facilities operate. And we walk down the whole production line process of how these things are. Oh, and by the way, that I said that one's 500,000 square feet, 5 floors. That's like one of 30 fulfillment centers in the UK and one of, I think, 185 fulfillment centers globally. And that's a small one. Like there are some that are like 2 or 3, 4 times bigger than that. So like, do you know the process? Are you familiar with how the robots actually work and how Amazon do this stuff?
Oh, I mean, I think I do. Like I saw clips. I don't know how different it feels seeing it in person, the massive scale you're talking about, but I think I have a decent idea of all kinds of machines just moving to the next part of the chain, and everything feels like I watch a lot of EOS, battery making videos, like how batteries put together. So I kind of picture that, but like massively bigger.
There's it's this really incredible process that I understood, but seeing it in operation at this scale really blew my mind. Like if you're say selling, I don't know, like hats, right? And you're using fulfillment by Amazon, and then Amazon say, okay, send us like 1,000 hats for this month, Christoph. Like, so, okay, like a truck will come and pick them up, or you'll get them to the Amazon warehouse, and maybe 10 boxes of hats come down the conveyor belt to like the first station, and the guy just like gets everything out of your packaging into these like plastic crates, and they go on a conveyor belt, and then whoosh, they're into the system. And then these crates go to like these different floors with these packers. Now it's so interesting. Like the packers and the pickers are like these 2 sides of the process. So imagine you're the packer, I think that's the right term. Like this conveyor belt, this carton arrives full of Christoph's hats. There's like maybe 10 hats in there. Maybe if you sent 1,000, there's like 100 of these crates loaded with hats. Like the shelf comes on a robot to the packer, and then he gets instructed, okay, like load like 2 units here and 2 units here, and he's like filling the shelf up almost randomly. And these shelves are like moving past this station where hundreds of these guys are all loading goods into these shelves. And then your hats are they came in, like I say, as a box of 1,000. There's now like 1,000 individual hats on individual like mobile shelves, just moving around this sea over 4 floors of the warehouse, all messed up and mixed up with every other item. And like the power of AWS is it knows where every hat is at every point in time. And these shelves are moving around. So when I place an order for one of Christoph's beautiful like bee hats, and maybe I order like some toothbrushes and some other stuff as well, the pickers, like this stuff is in motion constantly. The hat, like if there happens to be a shelf with like a toothbrush and a hat on it, then optimally AWS will try and bring those 2 things together. But the pickers then are taking like the items from my thing and putting it into like another carton. And so essentially my order gets assembled, but the people aren't walking anywhere. It's like all the stuff is moving around the people inside this giant, like football pitch sized kind of cage environment, which is why it's safe to kind of walk around, because you've got conveyor belts over your head and you've got all the robots in this kind of enclosed, like massive section in the middle of the floor. and then it goes off to get like enveloped up if it's small items or boxed up if it's bigger items, and then it's out the door. And I think the record for my local fulfillment center was 70 minutes from an order being placed to that order being in the customer's hands. And that's probably going to be like a common or garden time once drones are introduced. And Amazon now have permission. They're like doing drone testing in the US and I think in some parts of the UK. So, hopefully that happens soon. And then maybe we'll have like 17-minute deliveries rather than 70-minute deliveries.
I have so many questions and also a really strong, overwhelming desire to start philosophizing, which I'll sequester for the moment. I'll spare you for the moment. First question is, how do you see that factory, let's say, I don't know, call it a year or 2 years from now, when one of Tesla's AI Optimus robots becomes another part of the puzzle? What happens? What does that factory look like?
Yeah.
Are all humans gone at that point?
Maybe those picker and packer roles are robotic rather than human because Amazon is trying to streamline the process. It's probably two things in response to that. Like, I think you're always going to need humans. So, actually, no, interesting. Right. So there is a role called an amnesty worker. So I described this kind of football pitch size cage with thousands of these like shelves moving around, like some kind of like horror movie of like The Cube or something, all these different like deadly things driving around full of hats and all sorts of other stuff. Well, sometimes, I know, something may not have been packed properly and something will just fall out because these shelves are relatively tall. They're like, I don't know, maybe 2 or 3 meters high. And if something falls out onto the floor, well, then the robots can't run over it, so they sort of see it. But a human currently has to go in there, an amnesty worker. And then there's all sorts of devices they have to wear with sensors, and they have like a kind of iPad thing, and it tells them which path to walk to get to the thing that fell out of the mobile shelf. So that, and the robots within 3 meters of them, I think, all kind of come to a halt when they sense that like the human is walking through that area. I guess they walk through kind of relatively slowly, and it's like a kind of rolling roadblock. Well, I guess if you could send an Optimus robot in there to do that amnesty job and like pick up the thing that fell over or do some like minor, I don't know, repair, jiggle something if it got a bit stuck or something like that, then that'd be more efficient, right? You take humans out of the way there.
As I listen to you talking, it's just clear to me that the science fiction stuff is already here,
Cool.
but what's it called? The final end game of it all is also like quite visible already. It's just going to take a little bit longer to sort of add the robots. At which point we start talking about the more philosophical, existential stuff. And in this case, it's like, what happens when we actually solve via scale and robotics the problem of buying and ordering stuff, where basically humans no longer have anything to do with it? If you take a dystopian view of it, you might think, well, oh no, humans have been displaced, and what are we going to do with, it's like, I think of limited, maybe nostalgic view. But then if you take the other view and think, this isn't what humans are for anyway. There's no, like, humans are not, well, humans are weird creatures because we're capable of doing anything. There is no one thing that humans are. But I would argue one thing we most certainly are not are box packers, right? Because that's boring and there's nothing involving creativity. So I like your point where maybe from an investing standpoint, that what you're sort of investing when you invest in a company like Amazon is like they've clearly won. Like you said, no one's going to catch their logistics machine because it's just too domineering. So then all brick and mortar type activities, all like, who's going to pay for something really when you're going to get it much cheaper and faster within, call it, minutes from something like Amazon? Then, like, most things are going to go away.
Yeah, well, fulfillment by Amazon, they're trying to serve other companies that just want to use their, like fulfillment as a service. And you're right, like it's not a dirty job, but it's like a humdrum, production line style job. Interestingly, they gamify it a little bit. Like something I didn't mention, it almost fascinated me. Like even their non-operational processes, like culture and HR and stuff like that, even that's been automated and optimized to some crazy degree. So, for example, like if you're working in one of these like fairly mundane jobs, like picking and packing, and the robots, there's like a light just telling you what to put where, you're just like essentially like a flesh and blood like robot in the process. Like the thing will stop every hour and it will tell you to do certain exercises because it knows you haven't like moved in a certain way, and it will give you like, do some star jumps or whatever, like stretch this, stretch that, to help take your mind off the kind of mind numbingness of it. There's like a game you could play, so you could maybe be like challenging the guy next to you, or like, like a whole team challenging another team, or a fulfillment center challenging another fulfillment center to, like almost like, play some sort of competitive game, but driven by your efficiency at running the process, because you're trying to engage some cognition, I guess, because they had like employee burnout because of the nature of the job. So they've optimized everything to death, taken a lot of the humanity out of it, but clearly like the direction of travel for the company is to get the humans out as much as possible.
Okay, now I can't help myself because you said like you triggered my philosophical. You just triggered me, Badger. This is what I'm about to say, extraordinary complex, and I'll probably end up talking about it in over multiple episodes, but it's so important. It's this view. There's one philosopher that's famous for his critique about technology, Martin Heidegger. Um, but his worldview is very complex to understand, so I'm not going to do it any justice. But the thing is that he thinks of technology not as, let's say, each particular gadget or gizmo and new invention. It's more like a way in which the world operates. And when you have, call it technology, big capital T technology, as the main dominant view of the world, which is what we have now and have had, I guess, for about 150 years or so, then that worldview is the worldview defined by everything being seen as a resource to be optimized. This is not, and just before people draw the wrong conclusions, it's not to say that technology is necessarily bad. Forget your judgment, good or bad. Just the world we live in, the technological world, things like humanity itself is not, there is no saving humanity because everybody is being optimized. A quick fun fact, I mean, to make this clear, this point clear, we have departments called human resources, meaning humans are seen as resources. What do you do with resources? You optimize them, you make them more efficient. There's no inherent value to a human besides the resource bit. So when I see things like these kind of gamification incentives, I'm like, on one hand, that's cool because at least there's a little bit of care there and you don't want your employees going, insane, like Chinese workers, doing repetitive tasks that just kill your soul. But on the other hand, with this critique of technology, what I'm saying is this is at best a temporary like band-aid. And it's so clear that humanity as a whole, having solved this particular problem of efficiency, will need to find different ways of being. And what that is remains up to date. That's actually what philosophers do, is we kind of like ask ourselves, okay, what follows the technological age? So I'm sort of like left, hearing your story, Luke, I'm left with this feeling of bittersweet. Like it's a very ambivalent feeling. like, yay for humanity for figuring out this crazy building and figuring out these efficiencies that are just mind-blowing. And what lies on the other side of this, in some sense, is dystopian. But in another sense, like, what if we then open up all parking lots and shopping lots and we build like museums and places for musicians, right? Where before we were still stuck figuring out these efficiency things. So it's not all dark and gloom. It's just very complicated.
And I think we're both optimists about this generally, but we recognize like Amazon is they employ over 1.5 million people globally. Like they're a big one. They're going to be optimizing and presumably either, 10xing the amount of product they sell with the same number of people, or having like 2x the amount of product they're selling with like 1/10 of the people. But there's so many other industries that are going to get hit by technology in the same way. Like we talked about driverless trucks last week's episode, right? That's like many workers in North America, hundreds of thousands of truck drivers plus in North America, PAs, personal assistants. Like I can't wait until my phone can be a fully functional like virtual assistant. There's like another ton of people globally and countries that have built their exports to a large extent around like being the customer services for the rest of the world. So big impacts, but I'm optimistic that eventually, if we don't blow ourselves up, this leads to a better place.
Yeah, and this is sort of a indirect pitch for Tesla. It reminded me why when Musk makes a bold claim about just the immense amount of value that these robots will bring to something like this. To me, they're going to fit into these kinds of operations and just make the whole thing go. So that's cute. Yeah.
Alrighty, good stuff. Well, anyway, let me close it out by recommending the Amazon Fulfillment Center tour. We'll leave a link in the show notes, but just go check out amazontours.com. And I assume they're doing these in many countries. Do recommend it. Good use of a couple of hours, especially if you're a shareholder.
All right. We have an exciting new segment.
We do. And we have playing guinea pig, one of our OG Patreons, Paul, who's got a live question for us. Paul submitted this the other day. You and I have been chewing the fat over Paul's question, and we'll get into it. But before we do, let's hear from Paul himself.
Hi, Monkey and Badger. Greetings from down under. I've got a question mainly directed at Badger relating to his investment strategy. I've been semi-retired for 2 or 3 years now, age 63 now. Need my investments to generate some income to live off, but need growth and need to make sure the investments last the rest of our lives. I've got 60% of my money in growth assets. I've got cash covering 5 years worth of living expenses. I also generate a lot of dividends. About 60% of our living costs are covered by dividends, so very conservative on that front. But I've also got about 8% at the moment in REITs and about 10% in monopoly, duopoly type businesses that are not going to grow much but throw off good dividends and I think provide a bit of ballast in the event we go into a bad bear market. Badger, you've got far more percentage just in growth assets. So I thought that might be a worthy topic for you guys to discuss for people in our circumstances. Thanks very much for taking the question.
Excellent, Paul. Thank you. Great question. And Christoph and I really enjoyed listening to that and kind of fathoming out what advice we might be able to give you. Well, first of all, actually, no, this is not financial advice. No financial advice. But if this was kind of our portfolio, our situation, maybe the way to think about this is like, how would we manage it? So let's quickly recap. So Paul's portfolio, he says, some of the numbers are a bit conflicting, but let's try and sort of make a few broad assumptions. He's about 60% growth stocks. And he actually told me in a DM after sending in that question, he has over 60 individual holdings plus a bunch of funds. So pretty big portfolio, like broad portfolio. He's got enough dividend stocks that cover 60% of his living costs, which is awesome. That's really, really great. He's got about 8% of his investments in real estate investment trusts and about 10% in what he describes as being monopoly, duopoly type mature businesses. So kind of like safety stuff. And then he's also got 5 years of cash on hand He's in his 60s. He wants growth, but he wants his investments to last the rest of his life. And he considers himself as being very conservative. So what are your immediate reactions, Christoph?
I think Paul has set himself up well conservatively, and I'm naturally much more risk tolerant than he is. So on one hand, congrats, Paul, for getting yourself to this really stable, well thought out spot. And there's a whole bunch more that I myself would do without necessarily compromising your desire or need to remain conservative. So I'll start with my the first thing that came to mind was, and I don't know this, but I assume you don't have Bitcoin in your portfolio. And the reason that I'm thinking that way is because when I see a shareholder having 60 stocks, to me, that's a lot. There's a lot of redundancy there. Badger, you'll probably talk about this concept of diversification, but that means in my mind I could take something like, let's say, 5 random number, 5 of those stocks that aren't really changing much about how my portfolio is constructed, and now I add an entire new asset class to the portfolio, and in this case I'm nominating Bitcoin for that job. Why? Well, because it seems to serve the purpose of actually diversifying your risk, because it's a whole new category, and it doesn't hurt that Bitcoin is basically the best performing asset class of the last 15 years since these metrics were tracked. It has a compound annual growth rate of between 70 and 100%, depending on the years you track it. And one other thing I discovered looking into this is there's something called the Sharpe ratio, which basically measures, it takes into account the volatility of an asset, measure and adds it to or compares it to its growth. And so you want to be paid for extra risk that you take. And so the Sharpe ratio measures that, are you getting paid enough for the risk you took? And Bitcoin has the highest ratio, which is best, because it's saying even with the volatility that was involved in that class, you got paid way more than expected. And so that ratio is really, really solid, beating all other asset classes. So this isn't me pitching you Bitcoin again per se, but it's asking you to consider, well, if your goal is this, to remain diversified, and you've already have plenty of diversification, why not add something that extends your diversification and also has a stunning track record?
I've got a bit of a sidebar on this because you threw in Sharpe in the show notes. So I've got a question for you. So I'm going to ground you a bit more on what Sharpe is. It's like a measure of, for a portfolio or an investment or an asset, like it's kind of like, how volatile is it? So even if something like I'm beating the market, my portfolio is going up. And if I have a good Sharpe ratio, it's like I'm going up smoothly. And if I have a bad Sharpe ratio, I'm like jagged lines and all over the place. So anything a Sharpe above 1 is considered good. Like 2 is really good. 3 is excellent. Under 1 is suboptimal. Do you know what my Sharpe ratio is?
No, tell me.
0.05.
0.05.
It's terrible. Yes. All over the place. Massive, like, years where I've doubled my portfolio in 1 year, and then years where I've got like smashed. So yeah.
Right. Well, okay. So that's really interesting, because this is the surprising thing. I really don't mean this to be about Bitcoin, but I think, Paul, for you, it should be interesting to see these numbers next to each other. Most people, when they think about an asset like Bitcoin, they think, oh my God, it's a pure casino. It's just gambling. But in fact, in actual mathematical fact, it's more steady, so to speak, and more smooth than the S&P 500, though it's close because the S&P 500 is between 0.7 and 0.9. But it's so much better than something like gold, which is at only 0.3. And then you have bonds that are between around 0.5 and real estate around 0.5. And so it just goes to show you that I think until you look, dig under the hood, so to speak, you might be surprised at what's out there and what the actual returns have been. So yeah, I mean, I was kind of surprised because most headline numbers are like, oh my God, Bitcoin dropped 80% at one point. Sure, but that's made up that that it made up that and more, all in adjusted, all with an adjustment to the risk you took.
Okay. Right, but I think there's some bigger things we should say about Paul's portfolio though, rather than just like maybe like trim some things and add some things. Because I think so here's my sort of bigger pitch on what's going on here. I think there's a conflict here because Paul is in his 60s. He describes himself as very conservative, but he's got like 60% of his portfolio in growth stocks. Like that is not traditionally considered a conservative portfolio. That's a pretty like wild portfolio. Now I think Paul's obviously come at this. I don't know how many years in the market he has, probably a lot if he's got a lot of experience, if he's got this sort of real mix and broad array of companies that he's kind of picked up along the way. And I think that risk is offset to a large extent by the fact that he has such a big cash buffer. Like 5 years of living expenses is fantastic. Like I try and right now I'm trying to have something similar to that myself, because even if things go to absolute hell, I know at least I'm going to pay the bills for like the best part of a decade. And Paul is also insured to some extent because he has 60% of his like monthly outgoings covered by dividends, which is a fantastic place to be as a dividend investor. And that's a place I want to get to myself over, maybe by the time I'm Paul's age. But he's still got 60% of his portfolio in growth stocks. So that's a lot. Like, I think you have to sort of recognize that. But also, I think 60 stocks is a lot of stocks. Like you're not, I don't know at what point it crosses over from being like if I owned 15 companies, that's like a growth portfolio, and I've picked those companies presumably, and I'm like, I know what they're doing, I'm tracking them at some point, and I think 60 is definitely across the line. And I don't know where the number is, like 20, 30.
Yeah.
You own
Actually, Badger, I think I got the number for you. It's somewhere around 20.
Okay.
Where the threshold, I don't know what the exact calibration is, 96% or something, where everything past 20 becomes like only incrementally more diversified.
Right. So
I call it 20 to 25.
Yeah. And so let's land this point though, that you're right, that like you don't get any additional protection beyond let's say it's 20, it's probably something like that. I agree. You're not getting more diversification, and you're just creating more complexity and confusion. You might as well just own an index, because you basically are an index when you have that many stocks. Like, and it's just complicated. Like you can't possibly track 60 companies. It's like you'd never be able to do that. So maybe Paul didn't tell us when he shared the question. Maybe he's got like the large majority of his growth investing allocation in a much smaller number of companies, but he's literally like broadly 60 equal weighted companies. Well, that's just like insanity. I think I would, again, not financial advice, Paul, you've been doing this for a long time, presumably, you know what you need to do. But if this is my portfolio, I think I'd be looking to identify like my best names, maybe the best half to start with as a first phase, and then start to slowly consolidate out of like your least favorite half into your more favorite half.
Yeah, that's similar to what I was thinking. Except I would even get a little bit more conservative at the start.
Mm-hmm.
If you have 60, my goal would be to trim 20.
Right.
Because 40 is still a lot. But with those 20, now all of a sudden, it's kind of counterintuitive what I'm saying. I would actually, in order to diversify, I would actually potentially buy something like, as I was saying, a Bitcoin, because it's a different asset class. But then I might even do something like take the value of, let's say, 5 of those, and then create a sort of sub portfolio. I would call it my mini, call it 10x portfolio, where I know that I'm going to make 10 bets. One of them will probably do really well, and the other 9 I could easily let go to 0, right? So you have a 1 in 10 chance, but that one that's going to make it will way outpace the gains you would make, from keeping the others. And now you're even more diversified, because You have, for example, an investment in, the next best thing, whatever that might be. And you're not just a gambler betting it all on one. You've really determined, for the sake of diversifying, you've put your money on a very different kind of horse without compromising the original diversification, which you still have too much of anyway.
Mm-hmm. Yeah. And you don't need to do all this stuff in one hit, right? You could set yourself a goal of just making the portfolio a bit simpler over the next 12 months. And then, take a breath, look at where you are, and then maybe do like the next phase of simplifying a bit further. Maybe you did pick up like a bunch of 10x stocks, as Christoph described. Maybe a couple of them have done really well. So, maybe they become part of your new like focus area. And if you are starting to get like your favorite companies, like start doing a bit deeper due diligence, which you'll be able to do as you own fewer and fewer companies. You can start to focus and just understand the ones you own a bit better.
Right. In fact, there's that. And the other end would be, I don't know how, I think you have the same kind of emotional feeling sometimes when you look at your portfolio and you now know that some company that's a relic, you're no longer either interested in it or you have bad feelings about. I would look at those 60 and I would just mark at least 5 that if they were gone, like actually the better question is, would you buy them today? Right? And you just identify 5, start with those. And then you do a little bit of work, you research. And if you really don't care about them and they're just sort of, you prune those and then you set those aside in a cash bucket. And then next time there's a market correction, some extra volatility, or there's a stock pitch you hear that you like, you go on the boards, you talk to us on Patreon, and then you slowly deploy that cash. But there's no rush to do it, but you do it like piecemeal like that.
Yeah. What I think is a good test around this stuff is like if you're in the pub and you're chatting to a buddy and you're talking about one of your stocks, like if you can't explain over the course of like a pint what this company actually does, then you probably shouldn't own it, right? Like you need to know at least the basics of what the companies you're invested in, what they actually do. And, hopefully you can do that with all 60 of your growth stocks plus everything else you own, but maybe you can't. And be honest with yourself, if you can't, you probably got no business owning that thing.
I mean, that's kind of, law of the investing jungle. It's one of them, right?
Yeah. You know what the laws of the jungle didn't cover? And I think we should probably add a couple of laws in the future because I'm trying to become more of a dividend investor. Like I picked up Novo Nordisk 2 weeks ago, I think, for lots of reasons, but one of them was it was like an income investment. And that there's definitely this concept of some companies being like yield traps. I don't know if you've heard that term before. Like my buddy Albert helped me understand this because when I started looking at dividends in a really kind of naive way, I'd see companies which were, paying like 7, 8, 9% dividend. I'm like, well, just buy those, right? Amazing.
Free money.
Yeah.
Free money.
Exactly. Yeah.
No one else is seeing this.
Yeah.
Just you.
Exactly. But these companies are traps. Like the reasons these companies have to pay such high dividends is because like in the main, they're kind of dog shit investments. And you might be making a little bit of money in like the front door where you're getting paid your quarterly dividend check, but you're probably losing like your principal as the company's business model falls apart, it gets disintermediated and the valuations go down. So, you're looking for companies that pay a reasonable dividend that is kind of in line with the market. They have solid fundamentals, like they're good companies and you might want to own them even if they didn't pay a dividend. Ideally, you've got a combination of dividend and growth. And if you're a real like dividend hawk, then I forget the term, dividend kings or something, whatever the term is, but like these companies that have raised their dividend every year after year for like 20 plus years. So, there's all that glitters is not gold, I guess is the term here. Yeah.
This is what we see in the bond markets. I mean, it's the same thing. When prices of bonds fall, the yield goes up. They're inversely correlated because buyers need to have more reward for the lower price, lower performing asset. When prices go up, the yield goes down.
Yeah. Paul, you've obviously, you've got it nailed pretty much. Like sounds like you're in a good place. If you are covering 60% of your monthly outgoings with your dividends, fantastic. Maybe apply that test. Maybe look at I don't know, the top, I don't know how many dividend stocks you have, but maybe look at like the top 2 or 3 yielding companies and just try and be a bit skeptical about why they might be paying you such a big dividend compared to everything else. Hopefully there aren't anything like that. Maybe everything is actually really solid and reasonable, but like another test you can apply.
Yeah, so great question. I think there's a lot for everyone to take away from that kind of inquiry, and looking at your own portfolio with a magnifying glass is good investing hygiene.
And Paul, thanks so much for sending in the audio of your question. So if any other listeners, particularly if Patreons, want to drop us a line, then maybe, well, on the Patreon, you've got a message board right there where you can submit, and we'll tell you how to submit your question. And if you're not on our Patreon, which is patreon.com/Wall Street Wildlife, like go message us on Twitter. We don't really talk about our Twitter handles very recently, but I'm at 7Luke Hallard.
Yep, and I'm at 7 Flying Platypus. And it is lovely to connect with real humans, and it was good hearing your voice, Paul.
Yeah. Hopefully lots more of those. So do send your questions in or message us and we'll tell you how to send your questions in. We've got like a lockdown process.
Yeah, so thanks for being our guinea pig.
Great stuff. And one of the tools Paul might use to start to analyze his companies in a bit more detail is the excellent FinChat. So if you go to finchat.io/wildlife, I think if you go there today, as of recording, you're getting a 25% discount. And hopefully you've seen us. We've been tweeting furiously about that and messaging about that on Patreon. If you missed that, sorry, bad luck, should have paid attention. But you'll still get a solid 15% discount at Patreon, at finchat.io/wildlife.
Yeah, it's a fantastic tool. Badger, are you ready to become a beast of an investor?
Be a bee of an investor or a beast? don't want you blowing off on me, buddy. I am ready to be a bee of an investor.
Your journey starts here. Bzz.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.